Welcome to Thoughts on the Market. I'm Jonathan Garner, Chief Asia and Emerging Market Equity Strategist at Morgan Stanley. Along with my colleagues bringing you a variety of perspectives, today I'll be talking about the recent correction and ongoing bull market in Asia and emerging market equities. It's Thursday, April 13th at 10 a.m. in London. Asia and emerging market equities underwent a 6-week correction in February and March in what we think is an ongoing bull market. However, they've recently stabilized and begun to rally once more as we head into the new quarter. Importantly, the catalyst for the correction came from outside the asset class in the form of banking sector risks in both the US and Europe. EM assets suffered some limited challenges. For example, at one point, major EM currencies gave up most of their year-to-date gains against the US dollar. However, as investors appraised the situation, they recognized that little had actually changed in the investment thesis for the EM asset class this year. At the core of this thesis is the ongoing recovery in China. After an initial surge in mobility indicators and services spending, there is now a broadening out of the recovery to include manufacturing production and even recent strength in property sales. Like the rest of Asia and EM these days, Chinese growth is self-funded, in the main from domestic banking systems, which are generally well-capitalized and liquid. Indeed, just as question marks are now appearing over bank credit growth prospects in the US in segments like commercial real estate lending, the opposite is taking place in China as the authorities encourage more bank lending. Elsewhere, we're also seeing an encouraging set of developments in the semiconductors and technology hardware cycles, which matter for the Korea and Taiwan markets. Although end-use demand in most segments remained very weak in the first quarter, we believe our thesis that we are passing through the worst phase of the cycle was confirmed by positive stock price reactions to news of production cuts by industry leaders. We think stock prices in these sectors troughed last October, as usual about 6 months ahead of the weakest point of industry fundamentals, and the industry now has a lower production base to begin to recover from the second half of the year onwards. Elsewhere in EM, we recently adopted a more positive stance on the Indian market after being cautious for 6 months. Valuations adjusted meaningfully lower in that time frame, and we think Indian equities are now poised to join in the rally from here on an improving economic cycle outlook, as well as heightened structural interest in the market by overseas investors. India continues to benefit from ongoing positive household formation, industrialization, and urbanization themes, which are well represented in domestic equity benchmarks. Thanks for listening. If you enjoyed the show, please leave us a review on Apple Podcasts and recommend Thoughts on the Market to a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.